Hi everyone, welcome to this masterclass. Here I'm going to just show you what you're going to learn during this masterclass. I'm going to upload these videos one after another on YouTube. So my intention is that I start from the zero beginning to the advanced level, and you will become a master of trading afterwards. And we're going to have a lot of contents here. After each of these content, you're going to just go and check them on the chart, and we're going to have some back testing, and I'm going to show it on the live chart example so that it's going to be useful for you. So the very beginning of this education starts with candle forming. Okay, we're going to talk about how the candles form from the price ladder or depths of the market. So later we're going to talk about the building blocks of the market. Is it swing or are the candles that they are building the market? So later we're going to have the 5 methods of determining the swing points, and I will just explain 2 of them because the others are so easy to find on internet and we are not going to deal with them. So I'm going to explain the mechanical ones that it is your chance of making mistake goes to almost zero. So later we're gonna just see that how these swing form points form the structure and patterns of the market. And later we're gonna just talk about the candle momentum. And we have also swing and pattern momentum. Just we have 2 kinds of momentum. Both of them just complement each other and they complete each other. So later, we're going to talk about the market cycles and their transition from one to the other one. So, in other words, market cycles could be called structure, momentum, pattern, structure, momentum. So, we have, when we talk about the market cycle, we have some tips, price action tips like 3 types of the candles that we're going to face, all the candles on the chart, and how to combine many candles, multi candles to one candle. And we will talk about the break even points on the chart, leg one, leg two symmetry that Albrook's talk about it, and wedges or trade drives based on RTM or just like Albrecht just mentions them and calls them weight. So we're gonna have another notion like the pattern, candle to swing, so zones and overbought and oversold areas. So without further ado, I'll just explain the very first one. Okay, so how the candles form from price ladder. Some of you are familiar with the candles, so I'm not going to bore you to tears. And I'm trying to just explain this as fast as possible. And if you just get bored, please just uh, skip through this part or try to watch this video with the speed up mode. And here, whenever you just come to the chart, you're going to just see a lot of shapes that they're moving. We call them candles, right? So these candles end up being green or red, or you can just define the color. It doesn't matter. Here I have just, instead of green candle, I have blue one, and instead of red candles, I have these pink ones. So how do these candles form? So these candles can be formed based on the time, based on the tick, based on the range, or other ways that we can just form candles. Like we can have different kinds of candles like range, raincoat, I don't know, tick bars, point and figures, and such. So now let's just talk about the structure of a candle based on the time-based ones, because this is the one that we're going to work on. So whenever the candle is trying to form, it has a beginning, we call it open, and it is the end of it. So we call it close. So we have 2 points. One is opening and one is ending. So as far as the candle is live and it is not closed, we are not sure that it's going to be blue or it's not going to be red. We don't know if it is going to be bullish or it's going to be bearish. Bearish means down moving candles or red candles, and bullish means up moving candles or blue candles. So what does it mean up moving candles and down moving candles? So whenever we have the opening of the candle above the close of it, so it means that this is a red candle and this is down moving candle. And vice versa, whenever we have the opening of the candle down and the closing of the candle up, we call it bullish candle. So the color could be green, white, or blue, whatever you just define. So between these two time, so opening and the closing of it, we have some other movements up and down. Okay. So as far as the candle is not closed, as you see it here in the live candle. Okay. So we cannot decide where the closing of the candle will be. It will be above the opening, or it could be below the opening. And while this opening and closing and before the closing of the candle, we have some other movements that they are just here represented with the wicks, or we call them shadow, different names, and no matter whatever you call them. So as you see, opening of the candle is here. It tried to move up, but it couldn't succeed, and it couldn't sustain the move, and it went down. And we are still not sure that if it's going to be closed down or it's going to be closed upper than the opening of the candle. So the amount of the range and the price that this candle came and retest. So they're going to be kind of big. And so at the end of the day, we have 4 points: high, low, close, and open. So each candle has 4 points. So based on this, so we're gonna guess this is the kind of brick of the wall. Whenever you just if we just compare this chart with the building, so these are the brick of the chart, but they're not building blocks. Okay, the building blocks of the chart is or are swings. So here we have swing, here we have swing, here we have swing. So different people define the swings with different methods and ways that I'm going to explain. Two of mechanical ways that just they're eliminating the chance of making any mistake when defining it and when you're doing the analysis. So before we move on, let's see what is behind these candles. Okay, I have prepared a PowerPoint about it. So here we have some buyers that they want to buy, and we have some sellers that they want to sell at 101. So as we move on, so we can see that some of these uh, buyers come and interact with the seller at price 101, and they're negotiating and do their business. Now, at 102, we have no active seller, and we have some, as you see that this candle, when this active buyers and sellers are just exchanging whatever it is, like it could be Euro USD, it could be indices, it could be gold, it could be a stock or whatever. So this candle moves up, the price goes up, and it shows that there are some interest for, number of the buyers outrun the number of sellers here. So we have two active buyers, but because we don't have enough active sellers here, so these active buyers need to negotiate with this passive seller who's waiting here to sell at price 102. One of them are just negotiating with this one, and another one is just negotiating with this passive seller because we don't have active seller. So now these three people, and these three people are done with their business. Now it is their turn to just come up. But while they're done with their business, look at the candle. So the candle comes up. It means that the price goes up. And this is based on the demand and supply. So now when we have some sellers and we have some buyers, the number of the buyers are more than number of sellers. So now we have one more person here, okay, who's actively buying, and we have just one person here. We don't have as any aggressive or active seller, but we have one person who can talk to this person and another one with this one, and look at the candle. So again, now if it goes on and this continues, okay, we can have some other buyers and some other sellers, and also we have the candle, it moves up. But as you see, we have here wick or shadow. It means that they cannot sustain this move up, and number of the sellers for a temporary time, it goes down and it closes here. Okay, now you see that now number of the sellers here, for a moment, they are just more than number of buyers. So as you see, the second candle is just opening, and as the number of the sellers increasing, and there are more than a number of buyers. It doesn't matter aggressive or passive buyers. So they try to drive the market down, and the candle comes down as far as it goes to just 103. Later, it cannot sustain this move, and the number of the buyers, as you see, they are increasing, active and passive buyers. So they're becoming more and more, and they're getting rid of these sellers, and they buy their commodities or whatsoever. And later, after they're negotiating and they're done with their business, look, they cannot sustain this price, and the candle goes up, okay, to the opening of it. Now, the number of the buyers are increasing, and again, as we see that number of the buyers go up and up, we can see number of the buyers are going more, coming more and more, and our candle is going up and up. This is the way these candles are formed, and you can see these numbers. There are some platforms that they show these numbers of the buyers and sellers on the candles. We call them footprints, and some traders are just using these footprints to just see the number of the buyers and sellers. And there, because there are a lot of numbers are moving up and down, so it takes time to just become professional in reading footprints and DOM and such. But we're not going to do the same system. We're going to just try to simplify the system as much as we can. So we're going to just use pure supply and demand, and we combine it with market structure to make sense out of the market, the movement of it, and we try to decide based on supply and demand and market structure and whatever happens inside these candles. So, and these candles all the time, they're just moving up and down here. If you just, if we just continue this one, you can see that here we can just have some passive sellers, they become active sellers. So some of the active buyers, and they're just try to just negotiate and they do their business. And these are, guys, this is just an imaginary situation. We never have this kind of things, but the point is that you have to understand what's happening behind the scene and why do these candles form. And for example, if we have a candle that is forming here without just retesting this shadow here, we will have a fair value gap or imbalance in buyers and sellers. It means that there are some passive buyers that they cannot find any seller, and they're waiting here. So the just price comes back and retest this area to just wipe out this passive buyers. And these are the things that happen based on the volume, and we're going to see it on the chart, and you can just make sense out of them. So let's move on the chart, and let's talk about the blocks of the market. So are these candles the blocks of the market, or are these ups and down movement are the blocks of the candles? Okay, I mean the market, not candles, because inside each of these candles we could see that some movement up and down, movement up and down. So at the end of the day, after this whole movement and interaction between buyers and sellers, we can just see 4 points: high of the candle, low of the candle. It could be at the same time open of the candle, close of the candle, and we just move the other one. So again, it goes on open, close, and shadows up and down. So now let's move on the building blocks of the market. So here we're going to move on the live market. Okay, so I usually like to do the teaching on the live market so that you're not just feeling any gap between the real market and your education. So have a look at this chart here. This is a chart based on 5 minutes. Okay, as you see it here, we have 42 or 40, and it goes down. So the timer goes down, and this packaging of the candle is between open and close of it. Okay, and whenever we are just going to 0, 0, and time is up, so they need to deliver us a candle. Okay, so and there are some movement as you see here, up and down, but you cannot see anything on the candle here. Okay, we're just seeing some movement. Okay, some volatility up and down. But if we go down, what we are going to keep these candles on top of 1 minute candle. Okay, look here, we have 1 minute is done. Now, if we go to this one, these are 1 minute candles. What we can see inside this candle. So if we go inside this candle, 1, 2, 3, 4, 5. Each of these candles, okay, are 5 minute candles. But we can see the up and down movement, but we cannot see inside and details inside these candles. The same for this candle and so on. If we go to 5 seconds, so here we have up candles and down candles. But as you see, we have some movements inside this candle. We cannot see the detail of it here. So the beginning of the candle starts from here. So it goes down, it goes up, it goes down, up, down, up, down, up, down, up. it just goes down like this, up, down, and finally it is closing just right here at this point. Exactly right here at this point. So the opening is here and the closing is here, but we have some movements that they're really important, but we cannot see them. It goes from here to here. We can just see this up and down movements with wick, and here also this down movement. We're summarizing it as a wick. So the building blocks of the candles, sorry, the building blocks of the market is not these candles. These candles are a representation of buyers and movers, while we need to see the interaction, real interaction between buyers and movers. So that's why we cannot just count on just candles. These candles are just forming to move the actually to show the movement on the interaction between buyers and sellers. We're going to use them to just build our swings. Swings are turning points. Okay. So when we have a turning point, it could be based on the scale and time frame. They are different. For example, sometimes we have a lot of movements that they drive the price up, and later it comes down. And whenever we have this movement, and you can observe it, so like this U-turn from up to down and from down to up, we call them so downswing and upswings. Okay. Or we have different terms for them. We call them in market structure, they call them higher high and the lower low, or higher low or lower high. So I'm going to explain all of them in details in the upcoming videos. But the point of this video, point of this section was that, so the building blocks of the market is not candles, and the building blocks of the market is swing, and these swings and movement of the candles that they form these swings are important for us.